You probably have something on your end that gives me permission. Oh, here comes Ashley again. Maybe we can get her in this time. She'd go. So today's, as we said, main focus is the close and disclosure. Now we're gonna have a good conversation about the close and disclosure. We're not just gonna jump in because there are a few things that we need to talk about. And I think it kind of all starts, a great place to start, with just kind of reviewing some basic terminology, some words that we want to make sure that we understand about the closing disclosure settlement statement, and making sure that we have just a good understanding of the basics before we pick up the calculator and get started. Good morning, Ashley. Good to see you.
Good morning. I was having some technical difficulties. I'm sorry.
No, you're good. I'm glad to see you in. So sometimes you just got to hold your tongue right?
Yeah. Thank
Ashley,
you.
of course, if you will pull your chat up, I just put the link to our YouTube channel in there for you. So yesterday's
Okay.
recording is in there. And then, of course, when we get done with today's class, I'll put it in there as well. So you can go back and review yesterday. And again, I think the biggest benefit for this channel is going to be the ability to review today's class with the closing disclosure. I asked this yesterday. How many of you have had a closing yet? I think a few of you had. A few of you, a couple of you. So you guys are probably exposed. We're exposed to the closing disclosure, hopefully helping your buyers and sellers with that final number. Again, some of you may have not seen this before, and that's okay because you know, you got to meet it at some point. So we're going to walk through it today, break it down to the very basics, break it down so hopefully we can get an understanding on it. So this last piece of chapter 14 starts on page 486. And we're going to define some basic closing disclosure terminology. Make sure we understand just the words in general. We're going to talk about prorations. We have several different versions of prorate. We could debit one party, credit the other. How much do we debit and credit each party? So we're going to break that down. And then, of course, the star, we're going to go off PowerPoint and we're going to work a closing disclosure together. And then, as I said, I have a homework recommendation. I can't make it mandatory, but I can recommend it. So we'll talk about that and make sure we're all on the same page. And then that gives you guys the week. If you have any downtime, I do encourage you to check out the CD to help prepare you for that test next Sunday. So some basic terminology. When it comes to the closing disclosures, we're really only dealing with two things. An amount on the closing disclosure is either going to be a debit. A debit is a charge against a party. It's money that they owe. Think about when you go to the store after class and you swipe your card at the machine. How does that come out of your account? Doesn't it come out as a debit? It's money going out. It's money that you owe. Compare that to a credit. A credit is money coming in on your behavior, on your behalf. So you come home from the grocery store and you have a bonus check for work and you run to the bank and put it in the, deposit it in the bank. How does that check look on your end? That shows up as a credit. That's money coming in. So don't make debits and credits harder than what they are. It's either money going out or money coming in, either a negative or a positive. I know I asked yesterday if we have any accountants on the call and nobody fessed up. So either I don't or you don't want to tell me, that's fine. But one thing I've learned from experience is my accountants really struggle with this idea of a debit and credit as defined here. Because in accounting world, debits and credits mean something totally different. So if you do have an accounting brain, we just may need to unwire that a little bit just to help you get through this to better understand that. So take everything you thought you knew about accounting and kind of throw it out the window for a minute so we can get through this. We're going to deal with prorations. So let's talk about what a proration is. A proration is taking a shared expense between the buyer and the seller and making it fair. The thing that we almost always see prorated at settlement is this year's property taxes. So let me ask you guys something. It's what, June 18th? If you were to buy my house today, you're just going to buy my house today. Is it fair for either one of us to pay this year's taxes, 2023 taxes? Is it fair for me to pay the whole year? Is it fair for you, right? We pretty much took the year and split it down the middle, didn't we, almost? So we're going to make it fair by prorating this year's taxes. As we go into these closing disclosures and settlement statements, I want you guys to think of the settlement statement as settling everything between the buyer and the seller. If we go to closing today, we need to finalize everything. And that includes making it fair for the prorations, for example, taxes. We don't want buyer and seller to leave after that deed is recorded with any unresolved issues. So we're hashing it all out today at settlement. In North Carolina, when we prorate, and this is important, when we prorate in North Carolina, we're going to consider the seller responsible for the day of closing. We're going to talk about various things that we can prorate in just a second. I just mentioned taxes. If you were buying my house today and we were prorating the taxes, I, the seller, would get to pay taxes for today, the day of closing. So the way I always remember this, when our alarms went off this morning, the seller still owned the property. And at some point today, fingers crossed, that deed is going to change hands. So when we woke up this morning, the seller owned the property. Thus, they're the ones that get to pay for taxes today, be responsible for taxes today. Everything goes according to plan. When we wake up tomorrow, who owns the property? The buyer. You do. Can't call the buyer tomorrow, though, can we? So we have a brand new owner tomorrow. So they will start picking up their portion, their responsibility for taxes and the other things that we prorate. So typically what we see is a proration of annual taxes. That's what we're going to work on. We're going to see HOA dues as well, as if applicable. If the property's in an HOA, we need to hash out, we need to prorate those dues as well. The problem will have to tell you if the HOA dues are monthly or annually. There is no across the board, right? So the problem will need to specifically tell you. And then the other thing we're going to prorate, if applicable, is rent. So if the tenant is in place and the buyer's buying, honoring the existing lease, the buyer's going to get a new tenant. So when we talk about who's responsible, rent for our purposes is paid and due on the first of the month. So again, you're buying my house today and there's a tenant in place. I've already received rent for the month of June. Tomorrow you become the owner or the landlord, right? I'm going to be responsible today. So today I get to keep rent, the day's rent. Tomorrow that tenant is yours, right? And as your tenant, don't you want rent for your tenant? So in a sense, at settlement, I'm going to give you some money. I'm going to give you rent for the rest of this month. So we'll look at how that proration works as well. The other thing that we may prorate, I'm not going to talk much about this other today, but I do want to revisit it next weekend. It'll be a good opportunity to review. But I think the other thing that comes to my mind when we talk about other things that we may prorate is a situation where the buyer is assuming the seller's loan. Now, most of what we're dealing with right now is the buyer originating a new loan. But we may have a case, and we may come back into this, you guys, where the buyer is just going to take over the seller's loan. The seller makes the payment on June 1st, buyer buys the house on June 18th, and then on July 1st, the buyer makes the next payment. And I think we're going to start seeing this more and more in our industry, where the buyer assumes the seller's loan. I mean, last year, interest rates were historically low at 2 point something, 3 point something. This year, they're back up to 6 something, which, by the way, is not horrible, but is 6 something higher than 2 something. So I think as these interest rates kind of come back up and time goes on, these people that bought last year, may sell with an assumable loan, in which case you and I will need to make sure that we know how to handle that. So we'll look at that proration, kind of introduce you to that idea. Again, I don't want to do that today, though. I don't want to muddy the waters. So that'll give us something to look forward to next weekend, and we can talk about how that works. Understand this: a true proration is a debit to one party and a credit to the other for the same amount. Somebody is giving somebody some money. Let's put real estate aside for just a second. Pretend that real estate doesn't even exist. If somebody is giving you money, let's say I'm giving you money. I'm going to hand you a check right now. Here you go. When that check leaves my hand, that's a debit from me, right? It's coming out of my account. When it enters your hand, it's a credit, right? It's money coming into you. Did the amount on the check changed when it switched from my hand to your hand? So I basically just handed you money, right? So instead of handing you money, bring real estate back into it. And now what we're going to say, buyers and sellers are not giving each other checks. They're hashing it all out on the settlement statement. And what's happening is somebody is giving somebody some money. Somebody is making sure that they are paying for their portion or their responsibility of this year's taxes, for example. So a true proration is a debit to one party and a credit to the other. It'll be for the same amount. You may also have a double debit, which we will talk about. A double debit is not a true proration, because in a double debit, we're going to debit the seller their responsibility of the taxes, their portion of the taxes, and we're going to debit the buyer their portion of the taxes. So each party is going to pay their fair share. They pay it to the attorney. The attorney sends one check into the county for this year's taxes. Does the county care where the money comes from? Nah, they just want the money, don't they? So the attorney will pay that on both parties' behalf. Usually if we're doing a double debit, we're later in the year. Who remembers when the bill comes out in North Carolina? When did the tax bill come out? Remember taxation timeline?
September?
Yeah. Say that with confidence. That's right, September. So if we have a closing after September and taxes have not been paid, it's later in the year, right? Maybe it's November, December, something like that. Instead of having one party responsible for paying it, again, we do this double debit and the attorney just sends it on the property's behalf. To that point, if we have a closing before September, is there any way taxes could have been paid? If we go to closing today, have taxes been paid? Nah, the bill hadn't even come out yet, has it? So if you have a closing before September, the problem may not even tell you that they've not been paid. But we know they have not, because until the bill comes out, they can't even pay that. So we'll talk about double debits. Again, we'll break this down, pick up our calculator in just 1 second. Back in pre-licensing, we made it easy for you guys, didn't we? We said every month has 30 days and there's 360 days in the year. Well, guess what? Welcome to the real world. We're going to use the actual days. We're going to know the days of the month, and we're going to use the 365-day calendar year. For your test, once you guys start your exam next Sunday, in the chat, I'm going to put the month and how many days are in months. So I'm going to tell you in your chat that January has 31, February has 28. I think you guys have enough to remember and enough things to take up brain space than trying to remember how many daggone days are in August. I don't think that's fair to expect you guys to, in the stress of the test, to freak out about how many days are in a month. So for your exam, I will provide you with the number of days. Fair enough? As you're practicing, obviously you may need to look. If you don't know, there's the knuckle trick. If you know that, if there's that little song, I never remember that one, but there's like a rhyme or something. So, you know, if you want to remember it that way, that's fine. But just rest assured, you guys, I'll give you those days for your test. So that's one less thing that you have to worry about. The other thing, as we said, it's important that we say it again and again and again and again. The seller's going to be responsible for the day of closing. Either they will keep today's money or they will pay today's money, but they're going to be responsible when I'm prorating between the buyer and the seller. This is the problem topic. Because we're going to see some numbers, some figures that the buyer has with his lender. But that's between the buyer and the lender. What does the seller have to do with the buyer's lender, with the buyer's loan? Absolutely nothing. So a lot of times we think, oh, well, it's the day of closing and the buyer has to pay, for example, interim interest. Why are we charging the buyer the day of interim interest, the day of closing? Because interim interest is between the buyer and his lender. It's not between the buyer and the seller. So again, understand, when we prorate is when we're automatically going to consider the seller responsible for the day of closing. So again, we'll see that worked out. It's only when we have those shared expenses. Any questions so far? So we're going to walk through a couple proration scenarios, and I'm going to use taxes as our examples because that's the one that typically we see. We will talk about HOA and rent as well. But there's a couple different scenarios when we prorate. So let's talk first about taxes have been paid. Anytime you guys start to prorate, the first thing I want you to do is take the proration information from the problem, and I want you to put it in a visual. I think we decided that we like pictures. So we want to put it in a visual so we can see what it is that we're talking about. So if we're talking about this year's annual taxes, and the taxes have been paid, we know it's at least September something, after September. So let's go to closing. I don't know. Let's go to closing on November. When do y'all want to go to closing? Let's go on November 27th. That's a good day to go to closing. The seller going to own the property the front part of the year. The buyer owns the property the latter part of the year. So what I just did was took that word proration and I put it into a visual. Can we see each party's financial responsibility without picking up a calculator? Who's going to have a higher tax bill? Who's going to be more responsible for taxes this year? The seller, right? Yeah, because they own the property for the first almost 11 months of the year. So what all we did was just took, we know closings November 27th. We know it's a full year taxes. The seller owns the property the front part of the year, and the buyer owns the property the latter part of the year. The next thing I want you guys to do when you prorate, at this point, put your pencil down, stop and ask yourself, who owes whom? So if we're looking at this one, we have just said taxes have been paid, which means the seller has paid the entire year's tax bill. So if we ask ourselves, who owes whom, what are we going to learn? Who owes whom?
The seller owes the buyer.
So let's see, the seller's already paid. They've already sent their money in to Forsyth County.
The buyer needs to pay the seller back.
There you go. So put yourself in the seller's shoes. No, hey, I get it. I get it. When I prorate, this is hands down the hardest thing for me. And that's why I take the time, put your pencil down, breathe, and take the time to actually look at it, use your visual and think it through. Because once I get through this, then for me, it's picking up the calculator. And that's the part where I shine. But here I got to think a little bit, So put yourself in somebody's shoes. If you're the seller, you've paid the whole year tax bill, you haven't owned the property for the whole year. Don't you want some money? And so that's what we're going to do. We're going to collect from the buyer. So what we're looking at is a debit the buyer, credit the seller. Let's do that over here. And what the buyer owes the seller for is the day after closing to the end of the year. The buyer owes the seller for their period of time, the period of time that they own the property. The seller gets to pay taxes on the 27th, be responsible. So the buyer will pay taxes starting tomorrow through the end of the year. Obviously, then the next year's tax bill is going to be on the new owner. So they'll pick up next year. When we are counting days, particularly when we're counting forward, on the timeline, I need you guys to be careful with this because it's easy to miss a day. And it's really easy to look at this problem and say there's 2 days left in November plus 31 days in December. And if you think that, you just got the problem wrong. So I've come up with a highly sophisticated method to help you guys make sure you're counting your number of days right. Everybody ready for my trick? I want you to count it out on your fingers. How fancy am I? I actually want you to take your finger and say November 28th, 29th, and 30. How many days do they have left in November? Not 2, but there's 3 days left in November, plus 31 days in December, which means the buyer owes the seller for 34 days. Please don't miss the problem because you're off a day. Miss it because you don't know how to do it. Don't miss it because you didn't count right. Take that out of your guesswork and count it out on your fingers so we can see the true number of days that the buyer owes the seller for their portion of taxes. Questions on how I got the 34 days? So then the last piece, the property is going to give you the annual tax bill. If I want to take annual and break it down to daily, what do I need to do?
Just divide it by 365.
Divide it by 365. Yep. So we take annual, and I saw a lot of mouths move. So we take our annual taxes that the problem gives you. You divide it by 365 to get daily. Once you have that daily, then you times it by 34 days. And that shows us how it's going to show up on the closing disclosure as a debit to the buyer and a credit to the seller for that amount. So when taxes have been paid, the buyer will owe the seller for the period of time that they own the property, starting with the day after closing. Questions on this scenario?
I do have a question, and I don't know why I'm thinking this,
Please.
but what was it that I learned that was we only counted months as 30 and we did a three-
Pre-licensing world.
Okay, all right, because I was like, why is this? Because this doesn't mess me up, but the other one was just odd to me. So
Yep,
this is reality. Okay.
good. That's
All right.
common, Sharon. They did the 30-day months in pre-licensing because they think they're making it easy for you guys, but I agree with you because the idea of February having 30 days just goes against everything that we thought that we knew in life, you know? And in
Right.
pre-licensing, we don't get October or Halloween, I guess. We don't
Yeah.
get New Year's Eve, you know, and that's not fair. You know?
Right. Okay.
So yes, we get to do it. And like you said, our brains just adjust to that better. Y'all don't have to worry about leap years or, you know, anything like that. Of course, unless the problem says, I don't know what kind of closing disclosure problem you might find out there, but always do what the problem tells you. And if they want you to use 29 days in February and 366 days for a leap year, then that's what you do. You don't have to worry about that for your test though. It's a normal year for your test. Thank you, Sharon, for that question. Anything else so far? So this scenario, taxes have been paid. We also have a couple scenarios in a situation where taxes have not been paid. So again, when you guys prorate, when you look at these things, I think the visual helps. You will have scratch paper next Sunday. And I encourage you to utilize your scratch paper and draw things out so you can see it. Yep. So taxes have not been paid. If we're going to do the proration, credit the one party, debit the other, and taxes have not been paid, then this is the scenario where closing is going to happen before September. So we will in just a minute look at the scenario of closing happens after September and taxes have not been paid. So in this scenario, let's go to closing today. Seller owns a property the front part of the year, buyer owns a property the latter part of the year. It gets a little harder now to see who has the bigger responsibility, right? It's just by chance that this class is the middle of June. And we just took that and divided it right down the middle. But we have closings in June as well. So we've drawn it out. We took our information. We know that closing is today. Taxes have not been paid, which means at some point later in the year, the buyer is going to be responsible for the whole year's taxes. Now, hear me. I just said the buyer will be responsible for this year's taxes. They're probably not going to pay them, sit down and write a check and pay them, because we know their taxes will come from the lender out of their escrow account. So we say the buyer is going to be responsible, meaning it's coming from their escrow account. Everybody with me? And the amount coming from the escrow account is going to happen later in the year, and it's going to be for the entire year. So if the buyer's going to be responsible for the entire year, stop and ask yourself, who owes whom?
The seller would owe the buyer.
The seller would owe the buyer. Put yourself in the buyer's shoes. You're going to be responsible for the whole bill, but you didn't owe the property until halfway through the year. Is that fair to you? No. So what are we going to do at settlement? We're making it fair. We're settling things between the buyer and the seller. So the seller is going to be responsible for the first through the day of closing. Could you guys imagine a world where we didn't settle this at settlement? And now imagine that for just a second. The tax bill comes out in September. The buyer calls the seller. What are they going to do? Call the seller in November and say, hey, man, our taxes are due. Send me a check. Mary Ellie's already laughing. What's the seller going to say? They're going to say, ah, and hang up the phone, right? See why we want to settle things between the parties now? We're making it fair today so they don't have to worry about it later. So we have the seller owing the buyer for their responsibility. And what is their responsibility? Well, there's 31 days in January, 28 days in February, 31 in March, 30 in April, 31 in May, and then there's the rest of the 18 days in June. So the seller's responsibility is the front part of the year. Or I'm getting 169 days that the seller owes the buyer. Again, we would take annual taxes divided by 365 to get daily. Take that daily amount times 169. And there is our calculation on the closing disclosure. Credit the buyer, debit the seller for those 169 days. Taxes have not been paid and the bill hasn't come out yet. This is before September. Questions on this scenario? Can I erase? We good? Okay. The other scenario, taxes have not been paid, but now it's after September. That's the dividing line. Taxes have not been paid. There's one of two things that can happen. Either we do the proration of the credit the buyer, debit the seller, or we do a double debit. A double debit is not a proration. Remember, a true proration is a debit to one party and a credit to the other. So in this case of a double debit, both parties are going to pay their fair share. Even though we're not prorating, I'm still a visual person. I still like to see what it is that I'm looking at. So I have my year. Now we're going to go to closing. Closing's happening after September now. So let's go, I don't know, let's go October 15th. Seller still owns the front part of the year. Buyer still owns the latter part of the year. Closing's happening on October 15th. Bills come out, but taxes have not been paid. So now, instead of prorating, more than likely what the attorney will do is charge the seller for their portion, first day of the year through the day of closing. And then the seller for their portion, the day after closing to the end of the year. So each party will have a debit the seller, debit the buyer. The attorney takes the money. The attorney sends it into the county for this year's taxes on behalf of the property. That way, nobody has to worry about it.
And this is in a situation where it hasn't been paid, but the bill has come out.
Correct. So this is going to be after September. So we need to know the date matters, right? When we prorate. So just, I'm telling you guys, before September, credit the buyer, debit the seller. After September, double debit. That's that defining moment is when the bill comes out. By the way, if we are going to closing in June or March or at any time before September, we haven't seen the bill yet, right? So the best thing that we can do for a June closing is rely on last year's taxes. If they adjust a little bit from this year to last year, it's not going to be big enough. If the parties want to go hash it out in court, they can. But personally, I've never heard of that, being a problem when the bill comes out. It is what it is, right? I don't have a crystal ball. I can't tell you what taxes are going to be this year. So the best we can do is rely on last year's taxes. That amount. So two scenarios. If they have not been paid, we're either going to credit the buyer, debit the seller, or we're going to do this double debit. Again, take your annual taxes, divide by 365 to get daily. I'll let you guys count those days out if you want to. I think for me personally, when I'm double debiting, it's easier for me to count the shorter amount, right? And then just deduct that from the whole amount. That's you can charge the seller. But if you want to count out both parties' days, as long as the seller's debit plus the buyer's debit equals this year's taxes, you're off to a good start. Questions? Anything on prorating taxes? Several different scenarios to consider. I think the number one question from all that though is who owes who or whom? I do math. I don't do grammar. So somebody owes somebody. I can't spell to save my life.
I have one more question.
Yes.
And so again, once we calculate the number of days that each person owned the property,
Mhm.
we divide that number by 365 and then multiply it by 12. What did you say?
So we're going to take the annual taxes, what the annual tax bill is this year. We're going to take those annual taxes and divide that by 365. And that gives me daily taxes.
Oh,
That's
and
taking
then,
that annual amount and breaking it down to how much your taxes today, how much your taxes tomorrow, right? Every single day this year. And then we can times that by the number of days.
I got it. Thank
So
you.
in that previous, I think it was what, 164 days? Does that sound? Yeah. So we would take that daily amount and times it by that amount, because that's going to tell us how much one party owes the other. Yep. So just taking annual taxes and divide them by 365 to get daily. Thank you. Is that good? Bless you. There you guys go again. My husband was sneezing last night. Stop it. It's got to be something in the air, isn't it? All right. Can I erase the pink? Good. All right. Again, taxes, I guarantee you, you're going to see taxes on your exam. You might see HOA dues. I know in your practice problems, you might see HOA dues. Again, HOA dues, the problem has to tell you if they've been paid or not. There is no, assuming the bill comes out when. The problem with HOA dues have to tell you if they've been paid or not. They also have to tell you if they're monthly HOA dues, annual HOA dues, right? They have to tell them how it's going to be dispersed. So as far as prorating, HOA dues typically work the same as taxes. We need to draw it out, assuming this is monthly HOA dues. Again, we're going to closing today. Seller owns the front part of the month. Buyer owns the latter part of the month. Now the question is, have the HOA dues been paid already by the seller? Seller's paid the whole month. in which case the buyer would owe the seller for their portion. Or if the buyer's going to pay them later in the month, in which case they need to collect from the seller now. So again, whether or not they've been paid or not determines who owes whom. We take our monthly HOA dues in this example and divide it by the number of days of that month. So which month is it? How many days are in that month? So in this case, we would take our monthly HOA dues, divide it by 30 to get daily HOA dues. And then we can times it by that number of days. So HOA works awfully similar to taxes. Figure out if they've been paid or not, and then just ask yourself, who owes whom? The other scenario is rent. It looks just a little different. Guys, for our purposes, unless we're told otherwise, always do what the problem tells you. Again, I don't know if you guys are going to Google and looking for stuff to do. I can't validate the internet, right? So just always do what the problem tells you. But when we prorate for our purposes, when we're prorating rent, rent is due and paid on the 1st of each month. And it covers that month. June 1st covers the month of rent. So if we go to closing, man, we got a lot of closings today, don't we? Keeping those attorneys busy on Sunday. Okay, so we go to closing today. The seller's already collected rent for the entire month of June. The seller has rent in their possession for the entire month of June. So if we stop and ask ourselves, who owes whom?
Seller
The
owes
seller would
buyer.
owe the buyer.
Seller would owe the buyer. They got to pay the buyer the rent for their tenant, right? So today, the tenant is the seller's. Remember, when we prorate, the seller's responsible for the day of settlement. So in the rent scenario, the seller would get to keep today's rent, which means the buyer starts collecting rent tomorrow through the end of the month. July 1st, the tenant is paying their new landlord, right? So this is the only month that we have to hash out. So the buyer's going to get the tenant and the rent starting tomorrow. So they have counted out the 19th, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, and 30. Is it really easy to look at that and see 11 days if you don't count it out? If you look at that and you see 11 days, you just got the whole problem wrong. Not because you don't know what you're doing, but because you didn't count right. So again, take that out of the guesswork of the equation. Count it out on your fingers so you can get that right number of days. Take monthly rent, divide it by the number of days in the month. In June, that's 30. So take monthly rent, divide it by 30 to get daily rent. Times that by 12 to see how much we are going to debit the seller, credit the buyer. Debit the seller, credit the buyer. Questions on prorations? Do the visuals help? I like pictures. Again, the other scenario of prorating we may see is if the buyer assumes the seller's loan. Let's talk about that next weekend. Obviously, you won't be tested on that, but I do think it's important we run through that. My crystal ball tells me we're going to start seeing more and more of those scenarios. So obviously, I'm not here to teach you guys everything about that, but just put that thought in your mind and knowing I think we can expect that. Our firms will bring in training. They may even bring in a lender, right? If that's the case, if it does start gaining in popularity. But
Julie, my
It might be a
brother's
match.
actually going through that loan assumption right now.
is he giving it or receiving it? Is he selling or
He's,
buying?
he's buying.
Okay,
so
so he
down.
is assuming somebody else's loan.
He's working on that down in Florida, so it's interesting to listen to him as he's going through the process.
Yep, absolutely. We'll be hearing more and more of those, I think, too. So prorating taxes, prorating HOA dues, prorating rent for now. Another math calculation we're going to see on these closing disclosures is something called interim interest. So let's talk about what this looks like. First off, interest is paid in arrears. And the way I always remember this, when you guys see this word arrears, let's actually just see the word rear. Where's your rear end? Isn't it behind you? So when I say, look, if you're not sure, right? When I say interest is paid in arrears, when you made your mortgage payment on June 1st, you paid May's interest. When you make your mortgage payment on July 1st, you are paying June's interest. Whenever you make that mortgage payment, you're paying last month's interest. That's what we mean by interest is paid in arrears. You're paying the month behind you. When we talk about interim interest, I got a visual, I like my pictures. If we go to closing today, no, let's not go today. Let's go later in June. Let's go to closing on June 25th. Whenever the buyer is originating a new loan, they're not assuming the seller's loan. They are originating a brand new loan, their own new loan. And whenever the buyer is originating a new loan, they never have a mortgage payment the next month. So if we go to closing today, there is no mortgage payment due in July. If we go to closing today, the borrower's first mortgage payment is going to be August 1st. They get to skip the first, always. Skip the first. Why? If they were to make a payment on July 1st, that payment would include all of July's interest. Did the buyer own the prop? I'm sorry, June, all of June's interest. Did the buyer own the property for the entire month of June? Does it seem fair to make them pay interest for the entire month of June? It really doesn't, does it? So how do we make it fair? Well, we don't charge them a July payment. They always skip the first. So we go to closing today. Their first payment's going to be August 1st. When they make that payment on August 1st, they're paying July's interest. Do I have everybody so far? That's what I mean by interest is paid in arrears. So now let's put your lender hat on for a second. You're the lender. You originate a loan on June 25th. You know you're not going to get your first interest payment until August that'll cover the month of July. As the lender, at some point, are you not going to scratch your head and go, whoa, what about the interest you owe me for the rest of June? And that is what interim interest is. It's the borrower getting caught up on their interest payment. Interim interest is always from the day of closing to the last day of that month. Don't go into the next month. Interim interest is always the day of closing to the last day of that month. The lender is collecting their interest for the rest of June. They will get their interest in July when they make that first August payment.
Question.
Yes.
So essentially, is this the only one where the day of closing, you're actually charging the buyer
Great
and not the
question.
seller?
And I'm not going to say the only one, but I am going to say the reason why we're charging the buyer is because I'm not prorating. I'm not taking a shared expense between buyer and seller. So when we charge interim interest, that's between the buyer and their lender. So to answer Sabrina, yes, the buyer will have to pay interest on the day of closing for their loan. So that idea of the seller automatically being responsible for the day of settlement is only when we're prorating taxes, HOA dues, and rent. Thank you. So we have how many days left in June? 25th, 26th, 27, 28, 29, and 30. There are 6 days left. Again, the benefit of counting it out. Can I put this down here? Just plop that down there. Other questions so far? Next, we got to figure out how much, one step at a time. Other questions so far?
Yeah, so you said HOA was also the seller pays for the day of closing, correct?
The seller's responsible. Yep.
All right.
Taxes, HOA dues, and rent. So we have 6 days that the buyer owes their lender interest. So they get caught up on those interest payments. And that does include the day of settlement. So now what do? Now we need to figure out how much daily interest is. To calculate interest, we take the balance times the interest rate, and that gives me annual interest. The balance, let's talk about that word balance. On the day of settlement, the balance is going to be the loan amount. So the balance of the loan, what do you owe the lender? On the day of settlement, that balance is going to be the loan amount. So we take the balance times the interest rate to get annual interest. If I want to break annual interest down to daily, what do I need to do?
Divide by 365.
Divide by 365. So we take our annual interest, divide by 365, and that gives us daily interest. Now I know how much interest is every single day this year. We take that daily interest, in this case, times 6, and it's going to show up as a debit to the buyer at settlement. The buyer's paying their lender at settlement for the 6 days of interest left in the month of June. Interim interest is one of those things that you guys like to try to make harder than what it really is. All it is, Sabrina laughs because she knows, right? All it is, the buyers getting caught up on their interest payments so that they owe the lender. That's all it is. We're getting caught up.
I have a question. If they close on the first of the month, do they have interim interest, or is it just like come out on the next one?
That's going to be up to the lender, but they may charge for that month at settlement, and then the next month, right? But usually for our purposes, Trinity, the first. So in our purposes, if you close on June 1st, you wouldn't have a payment on July 1st. Your first payment would be August 1st. I think in the
Okay, so then
it's going to be up to each lender how they do that. You don't have to worry about a closing on the first, because that gets tricky, doesn't it? You guys, once you get out there, if you haven't seen already, I think one thing you're going to notice, a lot of agents out there like to try to schedule closing for the last day of the month. And the reason why they like to shoot for the last day of the month is interim interest. That's less the buyer has to bring to settlement. Now, with that being said, the last day of the month is busy, it's hectic, it's overbooked, there's a lot going on. This agent, I run away from the last day of the month. Seems like a good day to, especially if the last day of the month is on a Friday. Oh my gosh. So, it shakes out to, a couple $100 or so, $100, couple $100, right? I mean, we think about daily interest isn't that much. It's a preference thing. But if you wonder why you try to schedule closing for the last day of the month and the attorney is trying to work you in at a random time at like, 3:42, probably because everybody else is trying to get on the books that day too. And a lot of it is we're trying to avoid, if we close on the last day of the month and we're just collecting one day of interim interest, no payment on, see if we close on June 30th, no payment on July 1st, first payment is August 1st. So just a heads up, be wary of attorney's office the last day of the month. Anything else on interim interest? Obviously, we'll see this again when we do our practice problem in just a second. Can I erase all this? They have it. So let me stop sharing just for 1 second. We're pretty much going to go off PowerPoint for most of the rest of the day. You guys, there you are. So what I want to do now is just spend some time going over the closing disclosure, identifying the various fields. I think just spending time with the closing disclosure and starting to learn what goes where, obviously, so we understand how it works, how it can be broken down, but also it could save you guys some time on your test if you already have an idea of what goes where. So I'm in the online learning system, and we're in the section 4 material, and we have this blank closing disclosure. And page 1, how this thing works. First off, a couple things. The columns at the top here, we got a few things going on. So we have some borrower paid items, we have some seller paid items, and then we have stuff paid by others. And then you can see these columns, some of these columns are broken down even further. So there's borrower paid at closing, borrower paid before closing, seller paid at closing, seller paid before closing. One thing we said yesterday was that any money, all money that changes hands as a part of this transaction has got to show up on the closing disclosure. Obviously, the borrower paid at closing are things that are going to show up on the settlement statement. This is part of the money that they have to bring in. So even though something might have been paid before closing, for example, the appraisal report will always be paid before closing in the real world. The appraiser is not going to go out and do their thing until they've been paid. So we don't want to charge the buyer for the appraisal again, right? They've already paid it once. But isn't paying the appraiser money as part of this transaction? Money that changed hands as part of this transaction. So even though they've been paid, that check's been cleared, the appraiser's already spent that money, we still need to acknowledge that on the settlement statement. Same thing with the seller. What are their debits paid at closing? Or was there anything that they prepaid before closing? And then you have this last paid by others. The example we gave yesterday was mom and dad wanted to pay for the home inspection. Are mom and dad allowed to pay for the home inspection? Sure. We just got to make sure we put it in the right place. So others would be mom and dad. Always understand, remember this. I think this, again, is important that we just keep tucked away in the back of our brain somewhere. The parties to the transaction that we're talking about here are the buyer and the seller. Everybody else is a third party. That includes me and you, mom and dad, the lender, the attorney, the home inspector, the surveyor. Everybody else is the third party. So the several different categories, borrower paid, seller paid. The ones we are focusing on for your test, for your exam, for our purposes, are going to be the at closing columns. So that's where we're going to see most of our work. Everything on page 1 of the closing disclosure everything on page 1 is going to be a debit to a third party. You're never going to see a credit on page 1. So there's one way to help us remember what goes where. Everything on page 1 is a debit to a third party. Buyer or seller are paying somebody other than the parties to the transaction. So if we go through and look at the various categories, again, just getting an idea of what goes where. We start with some loan costs. You can say section A is origination charges. So if there's any discount points or loan origination fee. B is in boy, are services the borrower did not shop for. So those services typically include the appraisal. The buyer does not get to choose who the appraiser is. Remember, the appraisal is not for the buyer. It's not their property. It's for the lender. They just let the buyer pay for it. Isn't that nice? It is the lender's appraisal, so they don't get to choose. Same thing with the credit report fee. C is in cat, gives us the services the borrower did shop for. So there's our attorney's fee, deed preparation, title insurance, pest inspection, and survey. By the way, you guys see like some of these blanks here? This allows us to write in. So if we have something that's not already listed on here, we have the ability to fill in, or the attorney, I should say, has the ability to fill in some blanks. I think something, and helping you guys getting familiar with this form, is the numbered section. So as we just said, we got them numbered as A, B, and C. And you guys will notice down here that D is the subtotal of A, B, and C. So we're going to figure up all our costs for A, for B, for C, subtotal them, and that gives us D as in dog. Continuing down, debits to third parties. E is in Elizabeth, is our taxes and other government fees. So there's our recording fees, excise tax. F is in Frank, is our prepaids, your homeowner's insurance for the year. Mortgage insurance is our private mortgage insurance, our PMI, if applicable. Prepaid interest is our interim interest. They're prepaying interest for the month of June, for example. Any prepaid property taxes, which honestly, I've never seen that. I'm not really sure what that's for. G is in Jenny, is our initial escrow payment. So we talked yesterday about taking a couple months of taxes or a couple months of insurance to originate those escrow accounts, to have that little bit of cushion if those amounts go up. So we would put those under G, or we will put those under G when we look at this. And then H is in Heather. This is where you and I get paid. A broker's commission, the home inspection, home warranty. And then there's usually some kind of, I call it nickel and dime in them. This says courier fee. It might say wire transfer fee, but there's just one more little fee just to get them at the very end. And again, if we have anything else, we can certainly write that in here. So once we figure out E, F, G, and H, then I gives us the subtotal of that. So we're going to subtotal A, B, and C for D, and then we're going to subtotal E, F, G, and H for I. The bottom of this page then is J, and J is the total of the page. So we'll have the borrower paid at settlement, the seller paid at settlement. The bottom of page 1, J. For your test next Sunday, when we look at this closing disclosure, you're going to have 4 problems from the closing disclosure. You're going to have 6 math problems total. 4 from the closing disclosure, 2 are standalone proration problems. Woo, would I just give you guys some information there? All right. So for your test next week, one question is going to be, what is the buyer's J from page 1? The next question is going to be, what is the seller's J from page 1? So 2 of your questions come from the bottom of page 1. What is the buyer paid at closings J? What is the seller's paid at closings J? Page 2, now we bring credits in, now we bring buyer and seller expenses in. We looked at this yesterday in our book, obviously for, our purposes, we're comparing the loan estimate to the final CD. So we're not worrying about this section for our test. When you guys are looking at page 2, if you don't have a piece of paper in your hand, you will eventually right now. And when you're looking at page 2, I want you guys to do a little bit of origami with your piece of paper. And when you're looking at page 2, I want you to fold it longwise. Because page 2 is broken down to buyer and seller. And if we fold it longwise, if we just look at the left-hand side first, the left-hand side is all about the buyers. So I think when we're doing page 2, it's easier to break it down to buyer and seller. Buyer on the left, seller on the right. Let's look at one at a time. So if we're looking at the left, the borrower side, the buyer side, box K as in Kelly is due from the borrower. So everything in K is a debit to the buyer. K is all of the buyer's debits. It is money due from the borrower at closing. It is money that they owe. I don't know if you guys can see, but I actually like to write that on my piece of paper, like I just did for you guys in pink, so I can see everything in K are the buyer's debits. So what are their debits? Well, the sales price. Not the gist of our whole contract. The buyer promises to pay the seller. So that's going to show up as a debit from the buyer. Another debit we have was everything we calculated from page 1. All that money that they owe third parties, that J, that shows up as a debit to the buyer. And then if we're debiting the buyer taxes, we have adjustments for taxes. This is broken down city, county, and special assessments. In the real world, the attorney very well might break that down. For our purposes though, guys, we just know annual taxes. We don't know how much is going to be applied to city, how much is going to be applied to county or the school board. So for our purposes, we'll just have one amount right here. If the buyer owes the seller for HOA dues, for example, that would just be a write-in. And quite frankly, I don't care where you put it in K, just get it in K. So if we have HOA dues, we would write that in. So K as in Kelly is all of the buyer's debits. Still on the
Question.
left hand. Yes.
Would I put my rent dues there if I had rent?
Well, we would write that in, yeah, but we wouldn't be debiting the buyer. We'd probably
Okay,
be
that's right.
crediting the buyer. Yep.
That's right.
But yes, that would absolutely also be a write-in the right place. Yep. Still on the left-hand side. L as in Larry is all of the buyer's credits. So paid already buyer on behalf of the borrower. L as in Larry are all of the buyer's credits. Again, I actually like to write that on my paper. So I have K as a debit, L as a credit. What are some things that are going to typically be considered credit to the buyer at settlement? When we look at L1 and that says deposit, that's referring to their earnest money deposit. Remember let's back up. When we went under contract, what do we tell our buyer? You pay this at contract and it will be credited back to you at settlement. So now here we are making sure that we credit back that earnest money deposit. So L1 is our earnest money deposit. The loan amount on the day of settlement will be a credit to the buyer. The lender is bringing that money today on behalf of the buyer for them to use to purchase the property. If the lender doesn't show up with that money, can the buyer buy? Probably not, unless they have a mattress full of cash stuffed somewhere, right? We need that lender. We need that lender's money to be able to have closing to happen today. So on the day of settlement, The loan amount is a credit to the buyer. They spend the next 30 years paying the lender back. Any existing loan, there's our loan assumption. Buyer assumes a seller's loan. Seller credit, I'll talk about that a little bit later. L is in Larry 6. There's your due diligence fee. Again, they paid the earnest money, they paid due diligence at contract. And we looked our buyers in the eye and said, these will both be credited back to you at settlement. So now we need to make sure we do that. If taxes, if we have a credit to the buyer in taxes or HOA dues or rent, then these would be write-ins under L. So we tally up all of K, we tally up all of L. Debits minus credits tells us how much the buyer has to bring to closing. Cash to close from the borrower. Debits minus credits, K minus L. All of their debits minus all of their credits tells us how much our buyer has to bring to settlement. This is your third test question on the closing disclosure. The buyers, bottom of page 2, left-hand side. Questions on the buyers, left-hand side.
I do have a question.
Yeah.
Maybe it's because I'm just thinking about it wrong. Due diligence fees. So that's money's paid to the seller for their time for the buyer to dig into the house and all that. They get that back? I didn't think they got that back.
They will get it credited. They're not going to get the money back. But we can think of, when we're here, Sharon, we can kind of think of the earnest money deposit and the due diligence fee. They put down a down payment. So they've already paid it once.
Okay.
If we look at
All
our
right.
contract in chapter 11, that amount comes off of the purchase price.
Okay, so it's
Yeah,
really
the
not
purchase-
money for time. It's really money towards the house.
Exactly. It's credited back to them. Yeah, we're not going to hand them a check back, but we're going to credit because they've already paid that amount. So when
All
we
right.
look at our contract, it's like the purchase price minus the earnest money minus the due diligence. That's their balance due at settlement. Other questions on the buyer side? Buyers on the left, K and L. The right-hand side then is about the seller. Let's talk about the seller side. Again, I think it's easier if we talk about one and then talk about the other. Don't try to blend them, okay? Buyer and seller. On the right-hand side, the sellers, M is in Mary, is all of the seller's credits. M is in Mary is all the money that's due to the seller at settlement. Money they have coming in. So some seller credits, the sales price. Again, the gist of our contract. The buyer promises to pay the seller in exchange for the property. That promise to pay is money coming out of the buyer and into the seller. So the sales price. And then if we have any credits for taxes, if the seller is owed money for taxes, if we had HOA, we would write that in. So taxes and HOA, M as in Mary is the seller's credits. N as in Nancy is all of the seller's debits. It's money due from the seller. So M is in Mary is their credits. N is in Nancy, it's all their debits. An excess deposit, we'll talk about that in just a little bit. Everything that we tallied up on page 1 for the seller, debits that they owe third parties, things that we found under J, That number goes in N. We're going to transpose that number from page 1 to N when we're ready. Payoff of the seller's first mortgage, payoff of the seller's second mortgage. If we have a third mortgage, we'd write that in. Do we have other outstanding liens? The due diligence fee is going to be a debit to the seller at closing. They received that money when we went under contract, right? So now we need to undo what we did at closing. I know you guys said you're not accountants, but I bet we all know accounting 101. How do you cancel out a debit? With a credit. How do you cancel out a credit? With a debit. There's your accounting 101 lesson for the day. So let's back up for a second. Let's back up to when we went under contract. When we went under contract, two things happened, right? The buyer handed a check to the seller for the due diligence. The buyer handed the check to the escrow agent for the earnest money. The seller never touches the earnest money, do they? The seller only ever touches the due diligence. So when we went under contract, that due diligence fee was a debit the buyer, credit the seller. The buyer handed the seller a check. Now fast forward to closing. And how do we reverse that? We cancel out our debits with our credits. And now at closing, we're going to do a credit the buyer, debit the seller. We're just canceling out what we did when we went under contract. So the due diligence fee is going to go under L as a credit to the buyer. It's going to go under N as a debit to the seller. Consider this. Let's say we have a purchase price of $100,000. Parties agree to $100,000. The seller, the buyer and the seller contractually obligated for the buyer to pay that seller that amount, right? That $100,000, right? That's our agreement. Then we go under contract and the buyer gives the seller an earnest money check. Let's say $5,000. So $5,000 in addition to the agreed upon purchase price. If we didn't reverse that out, wouldn't the seller be getting more than what they were contractually obligated to get? Is that what they agreed to? Is that what the contract says, 105? No. So how do we get that back? We reverse what we did. So now how much is the seller getting? $100,000. That's why we have to cancel that out. So the agreement shakes out. The agreement works out. Other seller debits, still under N as in Nancy. We have our taxes there. If it's going to be a debit the seller for taxes, again, write in HOA or rent if applicable. Add up all of them. Add up all of N. And the difference is cash, hopefully, to the seller. All of their credits minus all of their debits tells us how much the seller's gonna hopefully get. If their debits are more than their credits, that's telling us how much the seller has to bring to settlement. So the cash from the seller, this is your fourth closing disclosure. Mary Ellie, I'll get that in just 1 second. That's your fourth closing disclosure problem. So your test is 4 problems from the closing disclosure. 2 questions from the bottom of page 1, 2 questions from the bottom of page 2, which means you got to do the whole thing if you want to get those 4 questions right. So to get, do I have to do the whole thing? Well, you don't have to do anything, but a question came in about earnest money being credited. Yes. And we credited that back to the buyer under L1. So L was all of our buyer's credits. Remember, the seller's not touching that money.
So if it's credited to, if the earnest money is credited to the buyer, then am I missing something for it to be debited to the seller?
The seller never touches the earnest money. The seller has nothing to give because they never received it. What's happening to the earnest money when we're under contract? Where's it hanging out?
In like an escrow?
And like an escrow. The seller doesn't have that money, so we have nothing to debit them. So the only thing we do with earnest money is credit the buyer.
Okay, that makes sense now.
Yep. The seller never touched it. So they have nothing to give. The only thing they touch is that due diligence fee. Question comes in, you get a blank one for the blank closing disclosure for the exam? Yes. As long as you have the ability to print. If you don't have the ability to print, please let me know like today. If I don't hear from you today, by today, I'm going to assume you can print. So if you don't bring one for the test, you don't get one. I don't have another way to get it to you if I don't know, you know, so let me know. Fair enough? So for your test, you have 2 pieces of blank scratch paper, and then you'll have a blank closing disclosure. And yeah, I'm going to verify it's all blank before we take our test. I'm going to see it. So don't just bring any closing disclosure. I need to see it. If you want to have a backup, I'm fine with that. Just let me see it. So that's kind of our soft introduction. There's a lot going on in this closing disclosure, right? Again, I know you guys just, is this your first true breakdown of it? For some of you that hadn't had a closing, this very well may be. So if this is the first true breakdown you've had, the first time you've really seen it, I'm telling you guys, the more you can expose yourself to it, and I promise you guys, if you can spend some time with this week, it's going to save you precious test time next week. So you're not hunting and pecking so much, right? Because just learning where stuff is half the battle. So if you don't want to do the homework assignment, that's with this week. I mean, that's fine. I can't make you, but I do highly recommend at a minimum, just spending time with this form and looking at what goes where. Remembering, if it's on page 1, it's a debit to third parties. You're never going to see a credit on page 1. It's money that the buyer and the seller owe a third party. Page 2 is hashing it out between the buyer and the seller. The other thing I want to point out, now that your piece of paper, you open your paper back up on page 2, now that your piece of paper has your D's and C's all over it, what's a debit, what's a credit? If we do our origami again, if I can show you another trick, instead of folding it longwise now, fold it halfways. And when we're doing our prorations either shake out as a debit to the buyer and a credit to the seller, K and M, or a credit the buyer, debit the seller, L and N. You guys see what we're doing here? So our prorations are going to go side by side. Either K and M, debit the buyer, credit the seller, or L and N, credit the buyer, debit the seller. Again, I like putting my D's and C's on here so I can see what's the debit, what's the credit. And I know I'm either working with the buyer and the seller, or I'm working with prorated taxes, HOA dues, or rent. Kind of manipulating the paper to make it work. Questions so far? Right. Take a break. I got 10:26. Come back at 10:36. We'll talk a little bit more about these debits and credits. Welcome back. Right. So we've kind of given you, again, an introduction to the closing disclosure, the breakdown of what's where. The second, or the other piece, I should say, I think that are pretty big in understanding this closing disclosure is also having an understanding of what's a debit to the buyer, what's a credit to the buyer, what's a debit to the seller, what's a credit to the seller. So to help you guys with that, I've created a little cheat sheet for you. So again, if we're in the online learning system under the section 4 materials, I have a document called Who Pays for What at Closing. We're going to go through this and do the breakdown of debits and credits. But again, I think it'll help you guys for the test on Sunday if you can look this over and have this idea. That's what takes all the time, you guys, is sitting there wondering, is this a debit? Is this a credit? And where does it go? So again, the more time you can spend with your cheat sheet, the more time you can spend with the closing disclosure, I think the easier it's going to be for you guys on Sunday. And because of all that is why I rearranged the class. So we're doing this today and not next Saturday afternoon. That just wouldn't seem fair, would it? So this is why we've given you guys the better part of the week to secure this. I cannot let you use the cheat sheet for your test. I know, I always get asked that. So let me just go ahead and get it out there. No, you cannot use this for your test, which again is why I'm giving it to you now. So let's go through and let's make sure we're good. Have conversations about who, what pays for what. Hear me. This is who typically pays for what. You always do what the problem tells you. You guys remember what I said when we first logged on this morning? One thing I like so much about real estate, and one thing I think you guys will learn as well, there's no, I used to joke, just take the word normal out of your vocabulary because there is no normal in real estate. Every single transaction is different. If we consider every property, every buyer, and every seller are unique, and the combination of the three makes for a unique transaction every single time. Even if this buyer terminates, the property and the seller are the same, right? But now we've brought a new buyer into the transaction. So even though two of the three pieces are the same, because of the new buyer, this is a different transaction than what it was the first time. So real estate is unique. So in the real world, or if you see a test question that says, for example, that the buyer is going to pay the commission, then do what the problem tells you. Do what the transaction calls for. So when we look at this sheet, we're talking about things that are typically debits and credits to buyers and sellers. Do I have everybody so far? We're always going to do what the problem tells us. So typically, things that are going to show up as a debit to the seller, we know they pay our commission. That was the first thing we learned, right? We know who pays us. So typically, the seller is going to pay our commission. The seller pays the deed preparation fee. The attorney will have a separate charge besides their closing attorney fees. They will have a fee to prepare the deed to get it ready to take to settlement. I always remember it this way. When the deed is getting when the attorney is getting the deed ready for closing, it's still the seller's deed. So they get to pay to have it prepared. The seller also pays excise tax. I'll refresh you guys on excise tax in just a minute when we do our problem. So in addition to commission, deed prep, excise tax, the seller is responsible for paying off any of their outstanding loans and liens. So if they have a first mortgage and a second mortgage and they never paid last year's property taxes, 2022 taxes, and there's a mechanics lien and a judgment, what else y'all want to put on them? They owe a whole lot of money, right? All of that will be a debit to the seller. They are responsible for their liens and their bills. When they pay off existing liens and loans, there may be a recording fee to show that these are paid off. So again, because it's the seller paying off their lien, the seller would pay that deed of release recording fee, anything related to that payoff. I just mentioned delinquent real property taxes. That's not the current year's taxes. If the seller never paid 2022 taxes, they will be responsible for paying for that at settlement. And then if they owe any personal property taxes, may those be delinquent or current. So if they haven't paid their taxes on the car or the boat or the RV or the motorcycle, whatever else they have, their toys, then they will be responsible for paying those at settlement. So these are things that we're typically going to see debited to the seller. Things that we may typically see debited to the buyer. Anything having to do with their due diligence inspections. Home inspection, pest inspection, survey, well, water, radon, asbestos, anything related to the buyer's due diligence process, unless we're told otherwise, will be a debit to the buyer. Again, we're changing markets. We're coming out of that strong seller's market. We're still in a seller's market, but it's not as strong as what it was. And as that pendulum continues to adjust and we find our way back into a buyer's market, we're going to see something come back into play that we haven't seen in a few years. And we're going to see, as part of our negotiations, the buyer asking the seller to pay some of their closing costs. The buyer's going to ask the money to help them pay for closing. And if it's in a buyer's market and the buyer's driving, is the seller more than likely going to have to start paying closing costs again? Probably, all part of the negotiations. So it might be that the seller is paying for the home inspection, but it is the buyer's responsibility to pay for their due diligence costs unless otherwise negotiated. So again, got to do what the problem tells you. So typically, they're going to be responsible for their inspections. The buyer's going to pay for their first year of homeowner's insurance. Any kind of insurance, you pay now for the service in the future. Y'all think about your car insurance. You pay your car insurance every 6 months. When you send that money in, you're covered under Allstate for the next 6 months. So you're paying for services in advance. Same thing with your health insurance. I pay mine the first of the month. That covered me for the month of June. So at closing, they're going to have to pay for their first year's homeowner's insurance policy. Anything having to do with the buyer's new loan. Discount points, loan origination fee, interim interest, private mortgage insurance, anything between the buyer and their lender will be a debit to the buyer at settlement. The buyer pays to have their brand new deed recorded. The buyer pays to have the lender's deed of trust. The buyer will pay those recording fees. I want to go back up just for 1 second and make sure we see a difference here. The seller pays to have the deed prepared. The buyer pays to have the deed recorded. When we're getting the deed ready to take to closing, it's still the seller's deed. The seller will pay to have it prepared. Once that deed is in the buyer's name, whose best interest that that thing be put on record? It's the buyer's, isn't it? So the buyer will pay to have that recorded. You guys see that difference? Prepared versus recorded. Other buyer debits, they're going to buy their new title insurance policy for them and the lender. Remember, title insurance covers the current owner. So today they're the buyer at settlement paying for their policy. Tomorrow they're the owner. Title insurance does not kick in until you become the owner. So when you see owner's policy, that's referring to the new owner. And they will pay for that at settlement. Their survey, closing attorney, and then those advanced escrow deposits. So we're going to see, like, for example, a couple months of taxes, a couple months of insurance. That'll shake out as a debit to the buyer. Other debits are going to be marked as POC or paid outside of closing unless we're told otherwise. The appraisal and the credit report fee. Again, the appraiser's not going to do their thing until they've been paid. The lender can't pull the borrower's credit report until they've been paid for that fee. So these are things that are paid outside of closing. These are the things that we want to make sure we get in the borrower paid before closing. If we put them in the borrower paid at closing, you got your buyer paying for the appraisal fee twice. Not what they want, is it? So putting these in the right place. Things that are just credit to the buyer. We talked about that earnest money deposit will be credited back to the buyer under L as in Larry. Also the loan amount or the loans, they're getting a second loan. Maybe they're getting a down payment assistance program. They're getting money in that way possibly. All that is money coming in on behalf of the borrower today. So their new loan is a credit. I put on here our prorated items, whether they've been paid or not. You guys good with my terminology down there, CS and DB? What I'm saying is credit the seller, debit the buyer, credit one party, debit the other. So I have that there. I kind of help put that prorating together. And then there's some double entry items. Double entry meaning they're going to show up on the closing disclosure how many times? Twice. So we have the sales price is a credit the seller, debit the buyer, and there's our due diligence fee. We're going to debit the seller, credit the buyer. We'll talk about, there's your, just FYI, the last of that there, your assumption of the seller's new loan. We'll talk about that interest on the assumed loan. We'll do that next Saturday. If there's any money in the seller's escrow account, tenant security deposit, or any separately sold personal property. I can't tell you how many times I've been with buyers and we've walked into garage and seen a nice car. I don't know cars, but I know a nice looking car when I see one. And the buyer almost always says, does the car come with the house? You know what I tell them? Anything's negotiable. Money talks, doesn't it? So if we do agree for any personal property, that's going to be sold separately, outside bill of sale typically. And that'll show up as a credit the seller, debit the buyer. Be careful with your buyers. Check in with the lender. The lender is okay with some personal property, but when that list starts adding, the lender may have an issue. So if we're going to buy the car and the dining room furniture and the master bedroom furniture and the John Deere green trailer, the lender's not going to go for that. So that's when we need to do an outside bill of sale. Remember, the lender's financing the property, not the stuff. So just make sure, and there's actually a note in our offer to purchase and contract that reminds us to check with the lender on personal property. The refrigerator's cool. Usually washer and dryer is fine. You start going personal property beyond that, I would talk to your lender just to make sure it's okay. Questions on our cheat sheet. Again, this is for you guys. Help you between now and Sunday kind of solidify that stuff. So again, under section 4, here's who pays for what, and then that blank closing disclosure. If you can't bring one, let me know. We will get you one so you have something for the test on Sunday. Questions about anything so far? So what we're going to do in class together, still under the section 4 material, we're going to do this in class CD example. So you guys have it here. You also have the solutions. We're getting ready to do it in class. Remember, we're recording, so you can come back and rewatch the recording, make a note. It's like, 10 to 10 or 10 to 11. So if you want to just watch this section of the recording, that'll help you find it. I also have some extra practice in here for you guys. There's CD1 with solutions, 2 with solutions, 3, 4. There's some down here too. They just added these. So there's a whole bunch of closing disclosure practice. Obviously, I don't expect you guys to do all of it, as much as you can to get you ready for that test. But again, I have a recommended homework assignment. So I'll talk about that when we're done with this, so we make sure we're all on the same page. So we know what we're going to talk about next week. So let me stop sharing. I got to get myself set up. I'm working on one monitor here. So let me do that and that. Where did it go? Nothing's ever easy, is it? Okay, it's about as good as I can get it. Let me come back and get you guys. What stuff in particular?
The forms and stuff that you have pulled up, like this closing disclosure where you're finding all of the practice problems.
So it's in the section 4 of the online learning system.
Okay, so that's also that's in the email that Lane sent us, right?
Yes, yes. How to set up your online learning system account. Yep. So you got to get that set up so we can access this. And it's all in the section 4. Yep.
Thank you.
Okay. This is what I can do. Does this work-ish? We can see our problem on the right. We see our closing disclosure on the left. I'm going to go through and fill this in, you guys. If you have one in front of you, you can follow along. If not, you can obviously follow around. You could take just a blank piece of paper and kind of do something similar. So you just kind of see how it goes, how it looks. And then I'll also have my my blank Word document to pull up for when we do some math. So can we see it good enough? Is this good? Okay. All right. When you guys do these closing disclosure problems, I always want you to start from the top and work your way down to the bottom. Don't try to skip around. If you skip around, you're going to skip something. Sometimes you guys show up and you say, well, I want to fill in A and I want to fill in B and I want to fill in C. Not all of these are going to apply to every transaction. So how do we calculate for this transaction? We follow the closing disclosure problem, which means we're going to be hopping back and forth between page and 1 on the closing disclosure. But this way we make sure we have all the information that we need for this particular transaction. So we're told this is a fact situation for a closing statement. We're told to use a 365-day calendar year. One of the first things we're told is that settlement is November 23rd. When I'm doing these on paper, I like to write my date at the top of both pages. So if I had a piece of paper in front of me, I would write November 23rd at the top of page 1 and the top of page 2. The reason I do that is because I know I'm going to have to refer to the date several times. So I write it on the page. It might save me a couple seconds on my test trying to find that. It's just a personal preference thing. We're going to work down through the problem. So we have a sales price of $249,650. No personal property, just real property. Who can tell me what I'm going to do with that sales price? What are we doing with that purchase price?
Putting it at loan origination. At
Say it
closing.
again. Say it
At
again.
closing for loan fees at closing.
Not a fee, not the sales price.
Okay.
Who owes it to whom?
The buyer owes it to the seller.
The buyer owes it to the seller. So I got a double entry, right? I got 2 parties to the transaction involved. We are going to charge them a loan fee for the loan amount, but when we're talking about the purchase price. So if we go to page 2, and on page 2, it's going to be a debit the buyer, credit the seller. So on page 2, under K as in Kelly, K1, I have a sales price of $249,650. And then M is in Mary, credit the seller, the sales price. So K is in Kelly and M, debit the buyer, credit the seller. Then we have real property taxes, $2,471 real property taxes paid by the seller before closing, and we're told to prorate at closing. So the first thing I'm gonna do, yeah,
Go ahead. Sorry.
no, I just don't want to miss any questions. The first thing I'm gonna do when I know I'm prorating is I'm gonna take the words, take what we're saying, and put it in our visual. So we're looking at this year's taxes. What divides the year, what separates it is the day of closing. The seller owned the property the front part of the year, buyer owns the property the last part of the year. I just took the idea of prorating and I gave it a picture. I put it in a visual. If you like the visual, I recommend you using the visual. We are told that taxes have been paid by the seller before closing, which means, back to our visual, which means the seller has already paid the entire year's tax bill. So now stop, put your pencil down, breathe, and stop, and ask yourself, who owes whom?
The buyer owes the seller.
The buyer owes the seller. The seller's paid the taxes for the year. Put yourself in the seller's shoes. Don't you want some money back? Who are you going to collect it from? The buyer. So the buyer's responsibility is going to be the day after settlement to the end of the year. That's what we learned from the timeline. When did they own the property? So the buyer has it for the 24th, the 25th, the 26th, 27, 28, 29. There's 30 days left, no, 7 days left in November. There's 31 days in December. So the buyer is going to owe the seller for 38 days. That'll finish out the year. Before we take the next step, what questions do I have on how I got 38 days, debit the buyer, credit the seller?
I counted 8 days because I counted the 24th. I thought
So
the
the
buyer.
24th, 25, 26, 27, 28, 29, there's 30 days in November.
Oh, for the rest of, okay. I did to the 31st, but you're right.
That's why I don't want you guys stressing out or how many days in November. Y'all got enough to worry about. Would you agree with that? You got enough to worry about and how many days. Like I said, they used to not let me do that. I actually had to teach you guys the knuckle trick. I got more important things to do in post licensing than that. So I'll just give you the number of days. Don't say I never gave you anything. My present to you. All right. So we figure out 38 days. Problem tells me annual taxes. Again, it doesn't give me the breakdown of city and county and school board, fire district, da-da-da. It just says these are taxes for the year. So my annual taxes are $24.71. I need to break that down to daily. So 2,471 divided by 365. And you guys on your calculator get something that looks like this. If you want to round and say 6.77, that would be fine. Don't get too crazy on your rounding and go out to whole numbers. If you want to round, always have change. We always need to go at least 2 out. Personally, what I know about me, the fewer times I touch my calculator, the less room for human error I have. Sometimes when I'm on my calculator, I get big old clunky fingers and they just hit whatever button they want to. So the fewer times you touch your calculator, the less room for human error you have. So we said 2471 divided by 365. I get this big long number. And if you just stop on your calculator, don't clear it, but just say times 38 days. That's how we're going to get the most accurate number. The most accurate. Now, again, if you rounded to 6.77, you're going to be off a penny or two from me, a little bit. But hear me, you can't miss a problem by rounding alone. So in other words, the answer choices aren't so close that if you're off by a few cents, you can't look at that and say close enough. Does that make sense? I would bank on the answer choices being off by maybe $6.77. Banking on you not counting your dang days right. But if you round it a little bit differently than me, you might be off by a few cents and you'll still be able to look at that problem and see close enough. So we took our annual taxes divided by 365 to get daily taxes, times that by the 38 days that the buyer owes the seller. So we have our final figure, debit the buyer, credit the seller for $257.25. Questions on how I got that? Before I erase it, we go back to the closing disclosure and see where that goes. I need to remember that number. Can I erase the pink? Everybody good? We go back. To our closing disclosure. We are still on page 2, and we decided we're going to do a debit the buyer, credit the seller. So we're going to see this twice. Once under K as in Kelly, and again under M as in Mary. K is all of our buyers' debits. Again, I don't have a breakdown, but what I do have is a place for taxes. $257.25, debit the buyer. And then we'll do that again under M as in Mary, M as in Mary, 257.25, credit the seller. The buyer owes the seller, you guys can see that. The buyer owes the seller, L, debit the buyer, M, credit the seller for their portion of the taxes. Questions? Up next, we have the due diligence fee for $500. What are we going to do with the due diligence fee?
Put it in L. 6
L, meaning a credit.
to the buyer.
Yep. So L is in Larry. I got a due diligence fee for $500, credit the buyer. What else are we going to do with it? Anything?
Debit the seller and N.
And debit the seller and N. So we credited the buyer in L as in Larry. And then we debit the seller N as in Nancy. So again, another one of those double entry. Double entry meaning we see it twice. By the way, for our purposes, we have everything on one closing disclosure. Remember, in the real world, you're going to have the buyer's information on one closing disclosure and the seller's on another. Then we have $3,500 earnest money deposit. What am I going to do with that?
L1 deposit.
That's right. Earnest money is going to shake out as a credit to the buyer. Specifically, we're going to put it under L as in Larry 1. Deposit is just our earnest money deposit. So you can see under L, if we revisit, L is all the buyer's credits. So there's their earnest money deposit and their due diligence fee. We're good agents, aren't we? We did what we promised when they went under contract. Pay me this money now, and it will be credited back to you at settlement. I got the seller's loan payoff of 138,425. Lender stuff does go on page 2. Lender stuff is not on page 1 because when we talk about the lender, it's an extension of the party. So the lender, yeah, technically they're a third party, but they're an extension of the buyer, the seller. So lender loan, loan amounts, payoff, all that is going to be on page 2, particularly for the seller's loan payoff under N is in Nancy. They have a first mortgage payoff of $138,425. N is in Nancy 4. There's their first mortgage loan. If they had a second mortgage loan, a third mortgage loan, we'd have to write that in. But all the loans they have to be paid off. I have a private mortgage insurance premium of $860. First off, let's back up for a second. When we see PMI, what kind of loan is this buyer getting?
Conventional,
Conventional, with their loan to value ratio being
less than 80 or 80%. Yeah.
80% or less. Yes. So PMI is a conventional loan charge. The lender will charge it when the buyers or when their loan to value ratio is 80% or more. So we don't even need the problem sometimes, do we? If we say PMI, we know this is a conventional loan. Some lenders charge the first year PMI up front at settlement, which is what we're looking at here with $860. Other lenders may take that $860, divide it by 12, and tack it on to the PITI payment each month. All lenders work a little bit different, but if it's conventional loan, somehow they're going to collect their PMI. Again, in this case, this lender's choosing to collect it upfront, $860. Fees and dues and charge to the lender, not the loan amount itself, but anything else about the loan amount is considered to that third party. So we're going to flip over to page 1 and we're going to look under F as in Frank. We have prepaids, mortgage insurance premium. I'll go up in just a second. Let me get this down. $840. F is in Frank 2. And if we go up, we'll see I'm gonna under the column, borrower paid at closing. So borrower paid at closing. F is in Frank 2 is our mortgage insurance premium. The buyer will also pay at settlement their first year of homeowners insurance. So that'll be part of the thing that the attorney does, a distribution of the proceeds from the sale. So once we have closing, the attorney will write a check to State Farm and send that in on behalf of the buyer to cover their first year. So the attorney's going to collect first year $684. Still on page 1 under F as in Frank. We have our homeowners insurance premium, $684. So for our prepaid so far, the buyer's been debited their first year's private mortgage insurance. The buyer's also been debited their homeowners insurance. What am I going to do with the deed preparation fee?
Page 1C,
I heard C, I heard debit.
page 1.
Debit who?
Seller.
The seller. So C is in cat, C2, and again, getting it in the right column. The seller paid at closing will have an $85 deed preparation fee. C2, C is in cat, seller paid at closing. The seller pays to have the deed prepared. Excise tax. We hadn't talked about that. We're getting ready to. Who pays it though? We know that much. Who pays the excise tax?
The
Seller.
seller.
Seller. Excise tax. I kind of joke. I don't know if it's funny or not, but the government, they're going to get you one more time. They got you when you bought it. They get you while you own it. And guess what? When you go to sell it, they're going to get you one more time. That's what they refer to as the excise tax. So the seller gets to pay taxes, grumble, grumble. Excise tax is always calculated off of the purchase price. So we come back up, we're reminded our purchase price is $249,650. And to calculate excise tax, $249,650, our purchase price. Excise tax is calculated on 5/100ths of the purchase price. So we have our purchase price, and we need to divide by 500. It's 5/100ths of the purchase price. And hang on, we're not done yet. One more step. 249,650 divided by 500 gives me 499.30. The other thing that we need to know about excise tax, divide by 500. Excise tax will always be a whole number. You're never going to have change with excise tax. And here's the trick. This is the government we're talking about. With excise tax, you always round up. Always round up to the nearest 500ths. So we took our purchase price, we divided by 500. I got $499.30. Do I have change? Yep. So I need to take one more step, round my purchase price up to the nearest whole number, nearest whole amount, which is $500. Purchase price divided by 500. If you have change, round up, always up. Before we look at where it goes, do I have any questions on how I got that 500? We've already said the seller pays it. We've already said they're going to pay it to the government, which we know is a third party. So still on page 1, under E is in Elizabeth. E2 is our excise tax. Seller paid at closing. E2 excise tax. Questions on anything so far? Can I erase the pink? I have $400 for a survey. What are we going to do with the survey? Is it a debit or a credit, and to whom?
It's a debit for the buyer.
Debit for the buyer. This is part of their due diligence, yes? Anything as a part of the buyer's due diligence is going to be a debit. The surveyor is a third party. So still on page 1. Now I'm under C as in cat. C5. We have $400 for the survey. Debit the buyer. Home warranty, the problem has to tell you, because that's a very negotiable item. There is no across the board, the buyer will pay it, the seller will pay it. So we haven't seen many home warranties in the last couple of years. Seller paid home warranties in the last few years, but they're coming back. We're getting ready to see big shifts in the market, you guys. I hope y'all didn't get into this market, this industry, because it's so easy to sell a house. It's not always the case. We're gonna have to start working again. Right? Open houses and all that good stuff. Question comes in, survey isn't paid before closing. We're going to assume that these vendors, these inspectors and investigators will allow the buyer to pay at closing unless we're told otherwise. So it's kind of like the home inspector. They send the invoice to us, we send it so they can put it on the, so they're all different. The market's different, the surveyor's different. So for our purposes, we're going to charge the buyer unless we're told otherwise. If they had been paid before closing, then we still need to make sure we put it on here. Just put it in the other column. But don't do that if that's not what you're told. So the home warranty, in this case, we're told is going to be paid by the seller. The home warranty is a third party. So we're still on page 1. Now we're under H is in Heather. H3, home warranty paid by the seller of $450. Each party has courier fees. Like I said, there's some kind of courier fee or wire transfer fee or, something. So each party has a $30 courier fee. In this case, they're going to be responsible for paying their own courier fee. So still under H is in Heather. H4, we're going to give $30 for the seller's courier fee. And then H5, we're going to give $30 for the buyer's courier fee. So each party's responsible for their own little fees. Who pays the attorney's fee? $650.
The buyer.
Buyer hires the attorney. So who gets to pay their fee? The buyer. Remember, the attorney represents the buyer in the transaction. Attorney's a third party. So still on page 1, back up to C as in cat. B1, buyer paid at closing. $650. Title insurance, I have 2 policies, one for the lender and one for the owner. Who pays for the new title insurance policies?
The buyer.
Buyer. So still under C as in cat, you can see here they lump it together, C3. You have title insurance premium, lender and or owner's policy. Sometimes they break it up, sometimes they lump it together. We're going to work with what we got. If you want to break it up, you're welcome to use it as a write-in. I'm just going to add them together. So I have 505.40 for the lender, and I have 64.60 for the borrower. So that gives me a total title insurance premium of $571. $570. What is it? There we go, $570.
I'm sorry, could you say that again? How'd you get the 570?
I just added the lender's policy and the owner's policy.
Okay, and then that goes at the buyer. They have to pay that.
C3, yep.
Okay.
They're paying for their new policy when they become the owner. It doesn't kick in until they become the owner, but they got to pay for it now. Because remember, we don't want to call anybody the next day and say, oh yeah, you owe me more money. Today, we're going to settle everything. We're going to finalize everything. Again, if you want to break it up, that's fine. You've got room in C to do 2 entries. Some attorneys do 1, some do 2. I got some recording fees. Usually it gives me a breakdown. For example, this tells me the deeds recording fee is $26. The deed of trust is $56. And then in this case, it gives me the total. If we add 56 and 26, we're going to get 82. These recording fees are under E as in Elizabeth. And you can see here on the left, we do have the ability, if you want, you can indicate those separate amounts if you choose. What I care about is you get the total. Under E as in Elizabeth, E1, $82 under buyer paid at closing for both recording fees, theirs and the lender's deed of trust. Who pays commission? Seller, I just saw every single mouth move. We know that, don't we? We know where our money comes from. So seller pays commission. Commission is going to be based off of the purchase price. So let me go back up because I got to refresh myself here. 249, 655. Just write that down. 249, 655. 249. Not even 655. See? 650. Okay. So commission is based off of the purchase price. So we have a purchase price of 249, 650. They are paying 6%. So total commission is $14,979. The problem goes on to say, commission 6% of the sales price to be divided equally between the firms. So when you see, as the listing agent, when you're going to take your sellers to closing and you see the seller CD, generally what you're going to see is half of the commission going to firm ABC, the other half of the commission going to firm XYZ. Okay, we're going to split it between the two. For our purposes, if you want to split it up, that's fine. On our CD, I only have one place for commission under H as in Heather, H1. So if you want to take the total commission and divide it by 2 and pay each firm down here, that's fine. Or if you just want to put the whole amount in, do one or the other. Either you put the whole amount of the commission in or you divvy it up and pay them equally between the firms. It'd be 7,000 and something for each firm. In the real world, this is where you guys want to make sure that your firm is collecting the right commission. Please remember, it's not always a 50-50 split. It's the agreement between the listing firm and the seller. It's the agreement between the buyer and the buyer's agent, buyer's firm. And always remember, this is where we like to get upset. Why is the check made out to the firm? Whose listing is it? Is it yours?
Brokers.
It's the firm's. It's the firm's listing. It's not yours. So the check will be distributed. Commission check will be paid to the firm. You will go pick that check up from the attorney's office. You will take it to your firm. They'll deposit it and process it. They will pay you. The attorney is not going to pay you. They're going to pay the firm. Questions on that? How we got that amount?
I'm confused as where you say split it up to pay each firm. How do you put that onto the closing disclosure?
We'd have to do a write-in. So ABC would get 7,000 and something, and then firm XYZ. So you would have the two different firms. You'd either have it here as we're doing in one, or we would have each firm, but we'd have to do a write-in because we'd have to spell out the firm.
Okay.
And in the real world, Ashley, that's what you're going to see, because the disclosure has to show X amount going to Julie's real estate shop and X amount going to Ashley's realty, right? So it's got to show the two different firms being paid.
Right. And that's correct. I have seen the closing disclosures look this way, but my thing is with the closings that I've had, I've never actually had to sit down and do this disclosure. It was kind of like done.
That's correct. The attorney prepares it. So we're not actually doing this, but we are reviewing it for accuracy.
So we just need to understand.
So for us to review it, this is a great way to do it. And honestly, guys, we're all friends here, right? Honestly, the attorney doesn't sit down and do this either. They have a program, they have a software. They go through and plug the numbers in and then beep, boop, boop, and it fills it in. So we just need to make sure that the beep boop boop works, and that's what we're verifying for accuracy. So thank you for that, because no, we don't do it, never. But we do need to make sure that the attorney software or whomever puts those numbers in does it right. Anything else here, commission? Now we got financing. I got a $212,000 conventional loan. We already knew that, conventional. My loan amount is $212,000. What am I going to do with that loan amount? How's that going to shake out? Credit, debit, to whom?
Buyer credit,
I say it again.
a buyer credit.
A buyer credit. That's right. So back on page 1, because this is money coming in on the buyer's behalf, it's going to be a credit, and it's going to be on page 1 because the lender is acting as an extension of the buyer. They're bringing them that money for the buyer to use. So L is in Larry. L2 is our loan amount of $212,000. L2 then we're told 30-year conventional loan with a fixed interest rate of 6.5%. Hang on to that. We need that. 6.5%. Then we're told to calculate interim mortgage interest, calculate interim interest. So let's talk about interim interest. If we're going to closing on November 23rd, first off, I'm going to closing on November 23rd. When is their first mortgage payment due?
January 1st.
Happy New Year. You're going to payment on November 23rd. We skip the first. We do not have a mortgage payment on December 1st, which means their very first mortgage payment will be due the first of the year. Interest is paid in arrears. Where's your rear? Your rear is behind you. I got you guys doing weird stuff, Donna, counting on your fingers and looking at your butts. I don't care, whatever it takes, right? So we make that payment on January 1st. You are paying December's interest. So what the lender needs to do at settlement is collect interest for November for the day they originate the loan through the last day of that month. Interim interest is always the day of closing to the last day of that month. So how many days are we talking about? We need to consider November 23rd, 24th, 25th, 26th, 27, 28, 29, and 30. There's 8 days that the buyer owes the lender for that interest. Anytime we figure lender fees, lender charges, anything to do with the lender, we're always going to calculate it off of the loan amount. What does the lender care about? They care about their money. How much money did they bring today? They brought $212,000. They brought the loan amount. So our balance times our interest rate, again, on the day of settlement, the balance is the loan amount. The problem's got to tell you the interest rate. The balance times the interest rate gives me annual interest. Balance times the interest rate equals annual interest. Now we need to take our annual interest and break it down to daily. So balance times the interest rate to get annual. Divide by 365. Your calculator probably gives you daily, something like this, 37.75, 3424. If you want to round to 75, that's fine. You'll be close enough. I'm going to choose, I'm not going to touch my calculator. I'm not going to clear it. Now that we have daily interest, we just multiply by the number of days. And here we can round. I get like 302.02739. So I'm just going to round to 302 and 3 cents. The balance times the interest rate gives us annual interest. Divide it by 365 to get daily, times it by the number of days. And now we know how much the buyer owes the lender to get caught up on their interest payment. And that's all interim interest does. It's getting the borrower caught up on their interest payment. They will pay that $37.75 for December 1st interest when they make the January payment. When they make that January payment, they're paying December's interest. Questions? Before we erase and go back to our CD. Can I erase the pink? Anybody have this? Okay.
So is the practice test in here very similar to the one we're going to take on Sunday?
As a matter of fact, the homework assignment I'm going to give you is very similar to what you're going to see on your test, which is why I give you the one that I give. And yes, it's all good practice. Back to our CD. Back up to page 1. F is in Frank. F3, prepaid interest, is interim interest. Honestly, you guys, when you reach out to me outside of class, that's probably the #1 question I get. Where does interim interest go? So I always want you guys to reach out to me if you have any questions, but hear me. Interim interest is also referred to as prepaid interest, and it's under F as in Frank, F3. Buyer owes their lender at closing for $302.03 for interim interest. How we doing? They hanging in there with me? It's not terrible, is it? May not be your idea of fun, but come on, is it terrible? You've done worse things, I'm sure. All right, then we got some loan fees. So you can see we have a 0.75% origination fee, $200 application fee, and then we got 1 loan discount point to be paid by the borrower. So let's talk about these fees. Remember, lender fees are always based off of the loan amount. Loan amount. What does the lender care about? Their money. Their money is the loan amount. So we're going to start our loan amount of $212,000. And the first fee we're going to calculate is our loan origination fee. They've got to tell you this. Again, there is no standard across the board. So the problem will tell you the origination fee, which is 0.75% of the loan amount. Oops. 0.75% of the loan amount. So I have a loan origination fee, $1,590. We'll see where to put that in just a second. We have a $280 application fee. This is different than the credit report fee. Some lenders charge this. If it's on the closing disclosure, charge the borrower. So there's $280. We'll see where to put that in just a second. And then the other one we have is one loan discount point. To calculate the amount, the debit for discount points, the number of discount points shakes out to the percentage of the loan. So one discount point is going to be 1% of the loan. If it were 3 discount points, it would be 3% of the loan. So just take the number of discount points and plop it in a percentage, and it's always going to be of the loan times 1%. So for discount points, we're going to see, let's see, this is our loan origination fee. These are our discount points. And then don't forget, we have that $280 application fee. Questions on how I got the amounts before we look at what we're going to do with it? On page 1, up near the top, section A is all of our origination charges. So A1, we have our points, which is referring to our discount points. A2, we have our loan origination fee. And then A3 is a place for a write-in for an application fee for $280. So we're all under A. A is in Apple. Discount points, loan origination fee, and application fee, buyer paid at closing. Questions? Can I erase the pink? Very good. Then for this problem, lender requires some initial escrow reserves at closing as follows. They're going to collect 4 months of taxes, 2 months of homeowners insurance, and 2 months of mortgage insurance premium. So we're going to escrow several things. When we come to this part, when we come to collecting some for the escrow deposit, we're going to base these calculations off of the numbers that we have. So we're going to have to go back up in the problem a little bit. So let's start with taxes. If I go back up in the problem, I'm reminded that taxes this year are $2,471. So if we have our annual taxes, $2,471, I need to take my annual taxes and break them down to monthly. Not daily this time, but monthly. So if I want to take annual and break it down by monthly, what do I need to divide by? See Mal's move? Yeah, 12. 12. So we're going to take our annual, divide by 12 to get monthly taxes of, not 1,000, goodness, no, there we go, $205 and some change, 92 cents, etc. Referring back to the problem will have to tell you how many months of taxes the lender wants to collect. So for our reserve, they want 4 months of taxes. So if we know monthly taxes are $205 and some change, now we just take that monthly, times it by 4, and I get 4 months of taxes for $823.67. And these are our taxes. So you just take the annual amount, divide it by 12 to get monthly, and then times it by the number of months. Do that again. This time, let's do that with homeowners insurance. They want 2 months of homeowners insurance. So if we go back up a little bit, we're reminded homeowners insurance this year is $684. I'm going to divide by 12 to get monthly. Problem tells us they want 2 months. So times 2. We get $114. This is for homeowners insurance. And then they also want 2 months of mortgage insurance premium. That's also known as our PMI. Private mortgage insurance, mortgage insurance premium, same thing. So again, we come back up a little bit. We're reminded our private mortgage insurance is $840. That's annual. Nope, divide by 12. $70, they want 2 months. So we're looking at $140 for PMI. So I have 4 months of taxes, 2 months of homeowners insurance, and 2 months of PMI. Again, we're originating this borrower's escrow account, the lender is. We're giving ourselves a cushion. So when taxes or insurance go up next year, we have a little bit of wiggle room. The lender can still pay these bills on the borrower's behalf. Questions on how I got the numbers before we talk about what we're going to do with them? Is that a question? No, okay. I'm like on alert. I see movement. I'm like.
It's a pesky fly.
Oh, okay. Well, you caught my attention. Yes. All right. So our escrow cushion, our escrow deposits, we're still on page 1. We're going to go under G as in Jenny. G1, G, all of G is our initial escrow payment at closing. So G1, borrower paid at closing, is our homeowner's insurance. G2 is our mortgage insurance or our PMI. G3 is our property taxes. So G is our initial escrow. Homeowner's insurance, in this case, we have homeowner's insurance, PMI, and taxes. Questions? Can I erase the pink? I like to ask because sometimes when it's gone, it never comes back, except on the recording. All right, so in the last piece of this, we're told we got expenses paid by borrower before closing. We said earlier they're appraised on the credit report. Unless you're told otherwise, they'll be paid by the borrower before closing. In this case, in this transaction, the buyer's already paid for their pest inspection. They've already paid for their home inspection. If they haven't been paid before closing, then the inspectors have sent the invoice in. The attorneys are adding it to the closing disclosure, and we're charging the borrower at settlement. But again, we always do what the problem tells us. When it comes to these paid by borrower before closing amounts, quite frankly, for our purposes, I don't care if you put them on or not, because these are not your test questions. However, if you choose to put them on, and in the real world, you will see them. But if you choose to put them on, I need you to get them in the right place. And where these are going to go is in this column, borrower paid before closing. So B is in boy. We have our appraisal fee for $450. We have our credit report for $55. Those are those services borrower cannot shop for, did not shop for. Because the problem's telling me so. I see the pest inspection was paid before closing. Pest inspections under C is in cat. C4 is our $65 pest inspection fee. And then the home inspection is down here under H, is in Heather. H2, again, in this case, because that's what the problem tells us, make sure you get it in the borrower paid at closing. Borrower paid before closing, I think I said that right. Borrower paid before closing is not what your test question is going to be. Your test question is going to be borrower paid at closing and seller paid at closing. So these are the columns that you and I care about. Questions, thoughts, comments, concerns? Now that we've been through the closing disclosure problem, by the way, for your test, again, don't forget, if you're not familiar with Class Marker, you have a Class Marker tutorial in your email from Lane. I do think if you don't know Class Marker, please look at that before next Sunday, so you know how to maneuver, so you know what Class Marker looks like for tests. So on the test day, you're going to have 4 questions. Each question gives you all the information of the problem, and then it asks you, what is the borrower's paid at closing J? What is the seller's paid at closing J? And then what's the bottom of page 2? My recommendation on test day is don't even try to answer the questions until you've completed the CD. So you have all the information on all 4 questions, but as soon as you see a closing disclosure problem on that first of the 4, just go ahead and do it, the whole thing, and then answer those 4 test questions once you've calculated both pages. So let's talk about things for just a second before we continue. Y'all put your pencils down. Put your pencils down for a second. Calculator down, down, down. Let me tell you how the way this form is actually done, how they expect us to do it, and then I'll tell you how I do it for my test, because there's a little bit of a difference. Again, we're trying to get you guys through. So in the real world, do you guys see, we've talked about A, B, C, we've talked about the different sections and categories. Do you guys see within each section, the top here is just a little, it's a little different shade of gray than the rest of it. It might be hard for you guys to see on my screen, but if you see it, you can see that this is just a little deeper shade of gray, this number at the top. In the real world, you're going to see section A tallied here. You're going to see all of section B tallied here and all of section C tallied here. I'm telling you guys right now, I have a problem with that. My brain doesn't see that, because when I was taught to add back in the day, I was taught to add down. Now, what are they doing? They're asking us to add up. So I do make sure these numbers are right when I calculate. In the real world, I want to make sure, I mean, even if I can't verify the amounts, can I just whip out my calculator and add and make sure it all adds up right? So I can help the buyer by verifying that things just add right. Once we subtotal A, subtotal B, and sum total C, what the form wants me to do is add A plus B plus C. So what they're looking for here is the subtotal of the first half of the page. Same little exercise, subtotal E, F, G, and H, I is the subtotal of that. And then the very last thing is to take D plus I for J. That's how you're going to see it in the real world. It's all going to be subtotaled. It's all going to be added up that way. For the test, my recommendation, if you see it better, I'm going to be a little bit of a rebel. I'm going to go against the grain. For me personally, I find all that subtotaling stuff confusing. So for me, I just straight up add. I don't worry about adding A and adding B and adding C and then adding them together. For the test, for me, I just add the whole way down until I get to J. However you see it, however you want to do it, I recommend do one or the other. Decide now how you want to do it. Don't try to toggle back and forth, because then you're at the test going, oh, what do I want to do today? Pick one. Either you subtotal all the sections and you do it the way the form does, or you do it the way Rebel Julie does and just add all the numbers down to get the buyer's J paid at closing and the seller's J paid at closing. So what I want to do now is give you guys a few minutes, and I'll leave my screen up. If you don't have it in front of you, you can use mine. So the first half, I want you to start adding buyer paid at closing and the seller paid at closing. And I'll move my screen down in just a minute, but just straight line add. And we'll look at those numbers. You guys have that so far? We keep going. Buyer paid at closing, seller paid at closing. There's the second half. We good to talk about page one? Close? Okay. Again, my suggestion as we're doing these, now that we have this complete and we're finalizing this, let's just focus on the buyer first. So buyers first on the left. Let's start with our buyer paid at closing. And I lost my cheat sheet, so I got to add two. So what are we adding up for buyer paid at closing? We got our discount points of 2,120, loan origination fee, 1,590, application fee of 280. We got our attorney's closing fee of 650, title insurance of 570, survey of 400. There's our recording fee, $82. Homeowners insurance, 684, PMI of 840, interim interest, 30203. Escrow deposits. And then the last thing for the buyer is their courier fee. So for the buyer's J, when I just straight line add, I get $8,625.70. You guys within a few cents of me? Buyers J, buyer paid at closing, J is one of your test questions. And basically what we're asking with J, how much do buyers owe third parties at settlement? Questions on how I got that?
I do. I'm a little confused and it's just simple. So where it said that the commission was going to be broke and divided equally by the firms. And if you put it, oh, I guess, never mind. I figured out what I did. I'm good.
Do one or the other. You do
Yeah,
the
so I did
14 or,
I
okay,
did the other, but I accidentally put one of the others into the buyer and it shouldn't have been the buyer. It should have been both on the seller side. So
Yep,
I caught
that's it.
what I did.
Yep,
Yeah,
yep,
I'm good.
good, good. That's a great way to learn, right? Yep. Now we look at the sellers paid at closing. Seller paid at closing. So we have our deed preparation fee, excise tax. There's our commission. There is the home warranty and the seller's courier. So we straight line, just add the seller's debits to third parties. I get the seller's J of $16,044. There's your second test question. One is buyer paid J. Another one is seller paid J. Questions on page 1 before we flip back over to page 2. When we go to page 2, before you guys pick up a calculator, I want you, the very first thing I want you to do, make note of the buyers and the sellers J. So there's 86, 25, 70, and there's $16,044. And before we pick up a calculator, I want you to take these numbers from J and let's put them where they belong on page 2. My fear is if we don't do it now, we're going to forget. So we have these numbers, the buyers J and the sellers J. For the buyers, remember K is all of their debits. And that includes the amount that we figured from page 1. Yep, just 1 minute. We're going to get a big break. You guys bear with me like 5 more minutes. We'll take a big long break called lunch. If you need one, of course, anytime you need a break. So from K, all of the buyer's debits, we took that number that we got in J and we put it in K3. Does everybody see that? K is all of the buyer's debits. So that includes what we figured on page 1. Before we do anything, let's do the same thing with the seller. N as in Nancy is all of the seller's debits, including what we figured on page 1. So $16,044. N is in Nancy 2. It's what we figured from J on page 1. Again, you guys, please do this first. As soon as you get those numbers on page 1, please put them where they belong on page 2 so we don't forget them. Questions? So let me ask you guys, you want to finish this out now and then take lunch, or do you want to take lunch and finish it afterwards? Makes no difference to me. Are we in the moment or do we need a break? Tell me in private chat your vote. Majority will rule. Now or later? Break now or wait till we're done? Is everybody in? Everybody voted? 1, 2, 3, 4, 5. Okay, I'm getting majority now. So again, can you give me like 10 more minutes and we'll finish this out. And then we'll take a nice long lunch. Okay. So to finish this out, remember, let's focus just first on the buyer. Buyer's on the left. So we're only going to look at K and we're only going to look at M. K is all of the buyer's debits. L is all of the buyer's credits. So we're going to go through and add up all the buyer's debits for K. We have the sales price. We have the amount from J. And we have what the buyer owes the seller for taxes. So when we add up K, sales price, what we got from J in this case, and the taxes, $257.25. We come down to the bottom and it says total due from borrower at closing for K. What we added up, all of the buyer's K's, the sales price, everything from page 1, and the taxes, $258,532.95. And then we add up all of L. L is in Larry. What are all the buyer's credits? We got an earnest money deposit, loan amount, and our due diligence fee. So all of the buyer's credits are in L. So now to figure out how much does your buyer have to bring to closing, we're going to take K minus L. 258,532.95 minus 216,000 gives us cash to close from the borrower. How much does your buyer have to bring to the penny? K minus L tells us your buyer has to bring $42,623.95. Buyer's on the left. Cash to close from the borrower, the bottom of page 2. That's your third test question.
Well, hang on a second, because I got something different. I got
What you got?
42,532.95.
I got the 532 too,
Yeah,
Let's see.
I think you miscalculated there.
or 523.
42. Yes, thank you. Thank you. So 42,532.95. Does that look better? Yeah, thank you. See, big old clunky fingers. You got to be careful. Now we look at the right-hand side. Buyer on the left, seller on the right. M is all of their credits. N is all of their debits. So when we look at the seller's credits, add up all their M. In this case, I got the sales price. And we got what they are to receive from the seller for taxes. They are credited this amount for taxes. So the sales price, and in this case, taxes. Again, down at the bottom, M, seller's credits, $249,907.25. N is all of the seller's debits. How much do they owe in total? So we've got the things that we calculated on page 1. We have their outstanding loan. We have the due diligence fee. We add up all of the seller's debits. Hopefully, for the seller, M minus N will tell us how much the seller's gonna get from settlement. Pause here for a second. If their debits were more than their credits, if N is more than M, then the seller will have to bring money to settlement. So hopefully N or M is bigger than N. You guys understand? So hopefully we have credits more than debits, which means if we take M minus N, we have our seller getting 94,000 cash to the seller. They will get a check when it's all said and done for $94,938.25. And there is your fourth test question on the settlement statement, closing disclosure. So the bottom, the two on the bottom of page 1, the two on the bottom of page 2. It's a lot, you guys. I know. And I know several of you, this is the first time you've really seen this, right? Broken this down. So you just met it today. Again, when we come back from lunch, I'll talk about some homework recommendations. Make sure you guys have plenty of practice. And, you know, please always remember, I'm around all week. So if there's anything I can do, if there's something you're uncertain about, something I can help with, please don't hesitate to reach out to me. Guys, I'm going to be honest, nothing hurts me more than when y'all show up on test day and say, I never really understood that. So please don't do that. Let me help now. Let me help this week. Is that fair? Never hesitate to reach out to me. So when we come back from break, from lunch, we'll, you know, answer any questions, obviously. We'll talk about some recommended homework assignments that I have. The homework assignment has a couple funny things going on. Remember, every single transaction is different. So you're never going to see a closing disclosure that looks like this one again. So we're going to help prepare you for some things so you can do the recommended homework assignment. Page 2, but you know, right? I mean, if you can't see that, you know that. So I mean, you know, reach out to me if I don't know why it wouldn't print right, but you're getting the same thing I am. So that's weird. Can you download it and then print it? Would that maybe work? Let me know if that doesn't work. Try that. Let me know. Okay, so we'll come back. We're going to finish this out. Like I said, talk about a few funny things, give you the assignment, encourage you guys just to practice, especially if you're not familiar with this, just to get you ready for that test on Sunday. You know, the more you do this week, the faster on Sunday you can get through that test and get out. If you don't want to do anything this week, you might take the better part of 3 hours next Sunday. So, you know, it's up to you guys, right? But, you know, we've rearranged the class to give you guys plenty of time. So I hope you take advantage of that time and utilize it. And then, like I said, we'll talk about how we're going to handle this next week. Lunchtime. Thank you guys for your patience. I know it was a big morning. So let's do an hour lunch because I know we didn't get that second break and I do apologize. I guess I just got into the moment. So let's take an hour lunch. Is everybody good with that? Okay, so we'll come back. It's 12:11. I'm just going to call it 1:10. So let's come back at 1:10. I'll try to log on at like 1:05, 1:06, something like that. And we'll start right back up at 1:10. Good? Good. Y'all have a great lunch. Don't eat too much. Everybody log out. And we will see you back at 1:10.